Hello and Happy New Year. I realize it's a little bit belated, but better late than never. My last video blog was done in December 2019, and my God, has the world changed a lot since the last time I was in front of you guys. So here we are in the middle of March, and we have seen in terms of the LNG markets, massive disruption in demand, massive disruption in supply, and a kind of unrelated but has a huge implication on us, a massive disruption in oil price. And so what does that mean? That means that we are in a very, very interesting situation. We are in a situation that I cannot remember the last time we were in. And just to kind of put things in perspective, I'm talking about energy equivalent prices first. So let's just talk about the price for a minute. As you all know, the LNG prices around the world are still largely linked to oil, but there is a growing spot market. And that spot market price, there's a few different people who are tracking that. One of them is the Platts JKM, the Japan-Korea marker. And the Japan-Korea marker represents a price that is roughly the price that a spot cargo or a short-term cargo will be going to deliver gas into the northern part of Asia, Japan and Korea. That Japan-Korea price has been around $4 for about 3 months. That is very, very low. We were looking at Japan-Korea prices being, above $10, $12 a couple of years ago. And then for most of last year, around $8 to $12, and now collapsed to about $4. And why is that done? Well, there's a few different reasons, of course. The Japan-Korea price represents the state of the weather in that part of the world. It's been a fairly mild winter, so that has really put an overhang on extra demand for heating gas. It's also the fact that we are in a situation where the China trade wars, before the coronavirus, before the COVID-19 virus came along, the trade wars had dramatically impacted China's demand of gas. So we were already kind of drifting downwards because China, along with India, is one of the largest buyers of spot gas. A lot of the other buyers, such as Japan and Korea, tend to buy it on a longer term basis. China has some long-term contracts, but also buys a significant amount of its gas on a short-term basis. So, what happens in China tends to have a big impact on the spot price. Well, the spot price was around $4 for a long time, for the last 4 or 5 months. And if you look at it, that really implied an oil price of about $24. Now, how did I come up with that number? This is a concept that has been around for a long, long time. I don't like the concept, but it is what people use often, which is an energy equivalent basis. And that's basically based on the premise that a buyer really is buying energy, and he's not buying either a type of fuel. He's not buying oil or gas. He's actually buying just energy. And from a buyer's point of view, if he needs a certain amount of energy that's measured often in British thermal units or joules, if he needs that certain amount of energy, he can buy it. He can get that energy from coal. He can get that energy from oil. He can get that energy from gas. Well, if the oil price and the gas price were at a certain level that will make that energy equivalent basis the same, the buyer is basically indifferent in terms of his cost, whether he buys that amount of gas or that amount of oil. Now, it's been calculated that 1 barrel of oil, and we all know what a barrel looks like, roughly, kind of those big old barrels that you see on the side of the road sometimes. Well, a barrel of oil, when you burn it, gives you about roughly 5,800 million BTUs, MMBTUs. Let me just check that. Yep, 5,800, 5.8 MMBTUs. So, and it can be as high as can be, depending on the heat of the oil, can be as much as 6.2 MMBTUs. So we use an energy equivalent of roughly 6 as a good rule of thumb. And what that translates as, that if gas was selling at $4, which it was, $4 per MMBTU in Northern Asia for the last 3 months, you multiply that number by 6. 6 times 4 is 24. And that should be the equivalent price of oil. Now, obviously, oil, till the last couple of weeks, was trading at around $60. So oil was a lot more expensive for a consumer. If he just wants the energy and he doesn't care about what form the energy is in, the oil was a lot more expensive for the consumer if you wanted oil versus gas. So that's often been the case for a long, long time. And gas has been sold at a bit of a discount to oil on an energy equivalent basis because Gas is harder to transport. Gas requires a lot of infrastructure. Gas requires regas terminals, ships, pipelines, etc. Oil can be moved around in the back of a truck. And there are less consumers, discrete consumers of gas than there are for oil. Everybody who has a car is a consumer of oil. And to consume gas, you need to have certain things. Of course, you have gas in your home, but you also have, a lot more cars and a lot more point sources out there for gas, for oil. So for the last X number of years, until the last time oil was 60 and gas was 10, keep in mind again, if gas is 10 and oil is 60, we again 10 times 6 is 60, so it's an energy equivalent basis. We kind of went out of whack, which is quite normal in terms of gas was trading at a big discount to oil. Well, and that's what it was until February when gas was 4, oil was 60. Oil should have been equivalent to 24, but oil was really 60. Oil was expensive. Well, in the last couple of weeks, because of completely unrelated events, which is the Saudi-Russian war going on, trade war, oil price war, we have now seen oil prices collapse. And guess what? Today's price is almost exactly 6 times the JKM price. JKM price is today something like 3.4, and that is pretty much equivalent. That should imply an oil price of 23, and that's pretty much close to where we're at. So what we are now seeing is that oil and gas are now trading at an equivalent price, but at a really low level, and that is a bit of a worry because at these prices, not only are oil producers outside the Saudi and the Russians going to be in trouble, and we're going to see that in the next few months, but also gas producers are trouble. A lot of the gas supply that's coming into the world today, the cost of the production, the cost of the liquefaction or the pipeline, the cost of delivery to the customer, the cost of regas adds up to a lot more than $4 an MMBTU. So that's about price. Now, what's happened about demand? Well, demand, of course, with the coronavirus, China's demand was, after the trade war, China's demand was already low. That was towards the end of last year. As the trade war impact subsided, we then started hitting with the whole coronavirus thing. And the coronavirus thing was, wow, what did that have a big impact on things? And so, we saw China pretty much, cut down all its industrial output for the month of, half of Jan and most of Feb. And now we're seeing this wave around the world that other countries are going to be hit as well. So the demand has pretty much collapsed. Oil prices collapsed. And so that has implication on the LNG contracts that were linked to oil. So those have collapsed. And at the same time, we're bringing more supply onto the market. And this new supply is coming from projects in America that are now, the first wave of American projects are all kind of just finishing their commissioning and finishing their whole startup process. And they're all coming along with the gusto. These are Cameron, Freeport, others, Corpus, Cheniere keeps on, Sabine keeps on putting out new gas. So we're seeing a lot more gas coming out of the US. We're seeing gas coming out of Russia. Those projects, the first wave has gone really well. And we're seeing the tail end of gas projects in Australia. We're seeing some smaller gas projects in Africa coming on. So at the end of the day, we're seeing a lot more supply. We are seeing lower demand because of the virus and before that the trade, and we're seeing a collapse in prices. So what does that mean? Well, I think we're in a bit of a tough time now. This 2020 is going to be, as I said in 2019, it was going to be a tough year. Well, I think it's even going to be tougher than we expected. We're not going to see a lot of new projects get off the ground. It's very, very difficult to see new projects, especially large projects. In America, the problem is the second wave of projects are so much bigger than they should be. They're so much more hubris, you want to call it, whatever you want to call it, greed, expectations, whatever. These new projects came out, that have been proposed for the second wave were all 10, 15, 20, 30 million tons. It's not trivial to do a startup greenfield project and produce 25 million tons. It's almost like it's unheard of. Even Qatar, which has the best system in the world for building infrastructure and has all the big companies involved and all the all the government regulations and the workers, et cetera, is now only 70 million tons, but it took them a while to get there. I use the example of Bontang, Indonesia. It took them 20 years to get to 15 million tons. And that's how LNG projects typically grow in size. But these second wave American projects all felt that they could come along and be 10, 12, 15 million tons. Well, that may have worked in a market that needed that much gas. And I think I've just made a strong case for the fact that the market does not need that gas. Right now, the market really doesn't need a lot of gas at all. If it needs gas, it just wants gas in incremental amount from different places. I think what buyers of the world are realizing is there's a lot to be said for not putting all your supply from one source, from one region, from one commercial model or one price index. It makes a lot of sense to take a little bit of gas from Middle East, takes a little bit of gas from Southeast Asia, a little bit of gas from Australia, a little bit of gas from the US, maybe some from Russia. In the end, you're never going to be that much out of the money and you're never going to be that much in the money, but you'll always be at a comfortable, fair price for your supply portfolio. So buyers, especially the Asian buyers, are looking for incremental small volumes of gas. That's where these large American second wave projects are going to be in a bit of trouble because there's nobody out there who wants 3 or 4 million ton contracts. And so that's why you've seen the share price of a lot of the listed companies, Tellurian, Next Decade, even Magnolia to a certain extent, all drop, 90%. And these were dropping even before the coronavirus stock market impact. So, I don't think that the optimistic estimates that people had about how much supply they were going to come along is really going to happen. That's just not happening. So what's going to happen? We're going to see a slowdown in new projects. We're going to see older projects, the legacy projects, have to make some decisions. Do they shut in or do they keep on going? Now, here's an interesting equation to think about. When you, as a buyer, buy gas from a typical traditional buyer of a seller of LNG, you buy it from Indonesia, you buy it from the Middle East, Qatar, you buy it from Australia, you're buying at a set price. You're buying at a price linked to oil. Let's just say, for argument's sake, you're buying at 12.5% of oil. Okay. And then you add a little bit, let's say $1 for transportation. And so, if oil is $25, your pretty much delivered cost today is $4.50. Now, of course, 2 weeks ago, it was a lot higher. But it's $4.50. If you decide, you as a supplier, that, I have too much gas coming, the buyer, I have too much gas, I cannot, sustain my gas purchases, I need to shut down, my demand's collapsing, I'm a Chinese buyer, I'm a Korean buyer, etc. My tanks are full, what do? If I shut in and I tell my supplier in Indonesia or Qatar, I don't want his gas, he has the right to say, well, you're going to pay for it anyway, and you're going to pay me the $4.50. That's 12.5% of $20 plus $1 for transport. If you are the buyer, on the other hand, was buying from the U.S., and a typical U.S. contract, the Cheniere contract, you're paying at 115% of Henry Hub, which is one of the hubs in America, plus a tolling fee of, let's just say, $2.50. Well, Henry Hub is about $1.60 today. 115% of that is going to be about $1.85 plus $2.50 plus a $1.50 transportation. You're buying at $5.80 into Asia. Now, that is, of course, more than your $4.50 you might be getting it from Qatar if the price in Qatar had gone down to the 12.5% of oil. So a rational buyer would say, well, I have too much supply. I need to shut down. I'm going to shut down my most expensive supplier, and that would be the U.S. And that it actually makes a lot of sense because the U.S., typically the take-or-pay component of the U.S. contract is the tolling fee, because you can typically buy the feed gas on a 6-month, 60-day or 30-day kind of a rolling average. So you can shut that supply down pretty quick, the feed gas. You can also, a lot of the tolling facilities, the tolling model facilities in America are running on a fact that you can also shut down your OPEX, at least to a certain percentage of OPEX. But typically, you still have to pay that tolling fee as your take-or-pay. And I said in this particular model, the tolling fee was $2.50. So if you shut down the U.S. supply in this particular example, you'll be out $2.50. If you shut down the Qatari supply, you might be out $4.50. So of course, that makes a lot of sense to do that. So what does that mean? Are we going to actually see shut-ins in the U.S.? Theoretically, yes, but I don't think it's that easy. There might be a few here and there, but it's actually quite difficult to shut in. First is it's very hard for the human nature to still be paying for a tolling fee and not actually get gas in return. You almost think, well, it's a sunk cost. I'm stuck paying it. I'm going to pay it and I'll do it. Maybe that's what happens. Also, typically you have arranged in the tolling model, you as the buyer have arranged long-term shipping contracts. You still have to pay for the ship. You're still paying $100,000 a day for the ship. You might as well pick up the gas and bring the gas back with you. And in the US, the gas price, is also dropping. So you're not going to see a lot of shut-in, but you will start seeing a buyer in Asia or buyer in Europe start looking at his different price decks, and he'll realize that not all his gas coming in is at the same price. Now, of course, if oil price goes back up again, suddenly the US gas is going to look really good again because the US gas is not linked to oil. So hopefully that kind of made sense. I kind of mumbled through that. I do apologize for that. But again, the key really is, if you're a buyer, diversity of supply, diversity of price formulas, diversity of commercial models. All of these are great to have at this point. And so you should have a little bit of every type of gas in your portfolio. And in today's world, that's not that difficult to do. So, with the low prices today, we're not seeing much arbitrage between Europe and America and North Asia anymore. We're not seeing a lot of cargoes move back and forth, because in the end of the day, we are seeing that European price and Japan price and Korea JKM price, and even to a certain extent US production price, all pretty much about the same. So, or a US FOB price. So we're all seeing all the prices the same. Makes it very hard for a lot of the new trade to get off the ground. Hopefully we'll get over this whole virus thing pretty quick, and we'll have a fast recovery and everything can be back to normal. But I think we should be prepared for the next few months of very few project sanctions, difficult decisions to be made by the buyer. Does he keep on buying relatively expensive oil-linked oil-linked LNG, or does he buy from the US, which is not oil-linked, or does he wait till or does he honor his take-or-pay contracts, etc.? There's a lot of decisions to be made. Hopefully that's some food for thought. Happy to have a discussion. Send me an email anytime. vchandra@natgas.info. vchandra@natgas.info. And we shall see you hopefully in the next month or so. Thanks. Bye.